Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Arijit Basu, Managing Director at SBI, joining in. Welcome to the show, Mr. Basu, and it's a pleasure having you as well. And I hope all of you are safe. My first question coming to you right now is overall, if you see from the time the pandemic has actually started to now, we've seen a whole host of changes that have come through. The way the economy has functioned has changed, and a lot of upfront, probably I don't know even how to put it, the kind of reactions that we've seen have been very different, and this has been a healthcare related issue which now has been coming into different economies, and I think no one is spared out of it right now. What is the sense that you pick up right now as to do you think all of us are in the right direction in terms of the economy first?
Thank you very much for having me on the show, and wish you and all your people working with you as also at home stay safe and sound. That is very important as we go forward and continue with the unlockdown process. So I think we have all seen how the last 5 months have panned out. But just to recapitulate what happened. So March was the date. March was the month in which the COVID coronavirus problem came to India in a way. And so that meant basically two things. One is, as far as the economy was concerned, we were able to virtually close the previous financial year in a pre-COVID situation, excepting maybe just in some industries would have got impacted in the last 1 or 2 weeks because maybe the retail malls, etc. But overall, most of the companies who declared their results, including we as banks, we were in a pre-COVID situation. And you have very rightly put it that it started, of course, as a healthcare problem. And initially, we were not even aware how long this will continue. The first feeling was that maybe if we do a lockdown, very strict lockdown for 3 weeks, which was the first announcement by the Prime Minister, maybe at the end of that, things would sort of taper off. But as we realized in the world also, it did not happen. And while that lockdown definitely was necessary, but it did have a very severe impact because everything was closed virtually from March to, not end of March to May. So in this financial year, almost 2 months. And June onwards, we started having partial reopening, which has continued in June, July, and going forward. So, number one, the healthcare problem, a couple of things. I think, yes, the numbers are rising because every country dealt with it in its own way. So, in our country, for example, being so large, to say that, you keep testing everyone who has come into contact and all that was really not feasible. So we tested as per a certain protocol. And those tests initially were a little lower than what we are doing now. So if you test lower, you will have less of positive cases. So what has happened is that over the last 4-5 months, our capacity to deal, I think, has improved. Yes, it's very, very unfortunate. A lot of lives, more than 50,000 odd lives have been lost, and each life is precious. But again, if you look at it, given what has happened in some of the most developed countries, I think we have tackled this much better than them, given especially the healthcare scenario that we have, the number of poor people that we have. And there were huge challenges, in the lockdown period also, the migrant laborers who suddenly we realized that they were not able to even live for more than 2-3 days and they had to go back, and the consequences of that followed. But overall, I think we have dealt with it. Today, we have come to a situation where if you look at any of the data which comes out from the states, There will be some people always disagreeing and saying this is underreported, but broadly, if you take it, this could be fairly accurate. And what it says is that the capacity of beds which are available, or the oxygen supply, initially it was thought that a lot of ventilators would be required. But very quickly we realized it was very few people went to the ventilator stage. It was basically provision of oxygen, those BiPAP machines and stuff like that, which would be required. So those things have really come up. And people have also, a large number of them, other than a few who are reckless, have learned to deal with this, as we have opened up in the major cities. And given that scenario, if you look at Delhi and Bombay, who were the most impacted, Delhi, sort of flattening of the curve is happening. The death rates are fairly low. In Bombay, I think, unfortunately, the death rate is slightly higher. But other than the suburbs, I think in the main part of Mumbai, it has started coming down. And similar situation elsewhere. Numbers are still high because we are testing much more. Say, I think if we had tested X number in the beginning of July, say just a month back, we are now testing 3X. So in 3X, if we test and the numbers go up by only 1.2X, that means we are better off. And we are able to also know a large number of people who are either have COVID or don't have COVID. So that's all that I would like to say about the healthcare part. I said this much only to put things in context that this situation is going to continue for maybe some time, and possibly till we get a vaccine which can be actually commercially distributed. So maybe 1 quarter, 2 quarters, or even it can stretch up to a year. But then unlockdown has happened. So very briefly, before you ask the second question, since unlockdown, June and onwards, middle of June onwards, what we find is that other than sectors which are very sensitive, people still don't want to travel other than essential. So travel industry related sectors like aviation, tourism, they would continue to be hit for some time. We also, hospitality, as I mentioned, but even other sectors linked to that would continue to impact. Retail malls, for example, people are not going to retail malls. These would continue to get impacted. But certain sectors which have opened up have now gone back to 60-70% of their business. And collections of both the banks and the NBFCs also, if you have seen in the results, have similarly gone up. But overall, the economic activity, their monthly figures are coming. It will still take some time to come back. My sense is that the best hope we have is that by the time we come to the festive season, which is about 2 months away, October and November, there will be a fair amount of seasoning out. And the second half of the year, which is always the busy season for the country, will be good in terms of economic activity.
Right. So, very well put up right now, as you said as well, Mr. Basu. So, right now, if you think of the banking system as well, in consonance to other industries, every industry is absolutely dependent on the banking side of business as well, because from taking credit to even in terms of managing their own liquidity, a lot of dependence comes in on the sector. Now, absolutely, moratorium has been provided. There are industries which have opted for moratorium. MSMEs have been supported as well. But do you think this issue, after providing a moratorium, after providing that liquidity, something will persist wherein you will have to see to it that a bad bank is something which becomes an absolute necessity at this point in time, so that we don't face any NPA issues in the future on the back of the pandemic?
Okay, I think good question, but to just address it in its proper perspective, I will go back to again March 20, with which I started the first question. That if you look at the year 1920,
Hmm.
for both the economy as well as the banking system, I
Hmm.
think two things stand out. One is, yes, we knew that there was a slowdown in growth, but
Correct.
what was good was that there was a lot of cleanup of the banking system, which banks, in consonance with the regulator and the government, had been able to do. So, if you look at banks' balance sheets, whether it is the private sector banks or the public sector banks,
Hmm.
they were much, much healthier and stronger, both in terms of the amount that is provided
Hmm.
for the bad loans which are already existing, and also in terms of the fresh accretion of bad loans which took place in 1920 and even in 18-19 financial year, as compared to the 3 or 4 financial years before that.
Hmm.
And that is due to a lot of factors. I'm not covering them. It is well known about the role of the asset quality review of RBI, the role that the IBC has played directly or indirectly in assisting this. But given the range and plethora of measures that were taken by various agencies, the banks were in a fairly good shape as at 31st March. You can look at SBI, you can look at the corporate facing. So what that did was that had COVID not happened, unfortunately, COVID has happened, so we have to deal with it. But had COVID not happened in March
Hmm.
for India, then 2021 onwards would have been very good years for the Indian economy. And
Absolutely.
which is why the government also was talking of the 5 trillion economy by 2025 and all that. So now, what has COVID done?
Hmm.
COVID has basically done two things. One is it has had an immediate short-term impact, right? Because there is a lockdown, your activity is completely slowing down. So the targets that India has as a nation, as an economy, will get some change, which will impact. So now, if economic activity comes back to full scale and normal by, say, the third or fourth quarter of this financial year, then that target of achieving that 5 trillion economy by 2024 or 25 may get postponed by another year. That's all. But
Correct.
the direction in which the Indian economy was moving, the strengths that are available in terms of our population, our the fact that infrastructure, there is so much to do, and so many others. And India is a growing economy which can take, and many of the right steps have been taken in forms of GST and all, which is now stabilized. So all those factors would have come forward. Now, to come to your question, COVID has happened.
Hmm.
So we have to deal with COVID. So because we are starting with a position of strength, it makes it much easier to deal with the problem. So we know these companies which are good as on the 1st of March, as on the 1st of April 2020, without COVID, they would not have come to this situation, right? Because if they were, there were a few that we have distinguished them.
Hmm.
Few accounts which we called SMAs and all that were there as on 1st March. So those companies, even without COVID, may have faced a slightly challenging time. We have to deal with them separately.
Hmm.
But the ones that have been impacted only because of COVID, two things happen. One is that means their business model is broadly right? And the margins and leverage that they have are manageable,
Hmm.
right? So if some interim support is given to them in whatever form, moratorium is one form, but there are other forms in which interim support can be given.
Hmm.
Then for a short period, if that support is extended, then maybe 4 or 5 quarters down the line, they are able to come back. And that is precisely what everyone has done,
Hmm.
whether it is the government, whether it is Reserve Bank, or whether it is the commercial banks themselves. So I'll start with commercial bank. So as soon as COVID happened, if you recall, even before the governor made his first announcement at the end of March, SBI came up. We said that we will give an additional 10%, what we call the emergency credit line, CECL, right? Then RBI, the government itself announced, finance minister has gone on record to announce 3 or 4 major steps over a period of time.
Hmm.
Reserve Bank also understood that if you have a lockdown, then there is no cash flow. So where will you repay? Initially, they said 3 months because it was first expected to last for 3 weeks or 1 month. Then as the lockdown was extended, it was done. So all those things have really helped. The latest announcement by RBI on the way in which all banks can come together and do restructuring in cases where it is required. Okay, you can go ahead and do it. This committee will also give its report in a couple of weeks, and then by the time the moratorium ends, we will have a fair picture of which are the companies which will need support. So my sense is that two segments of industries will genuinely need support. One is the high impacted industries, which I explained would be hospitality, tourism, and maybe the retail malls and things like that. And there also it will vary because some of them have very strong promoters who would have cash from other resources to be able to meet this period. And no one wants to get into a tangle. But the MSMEs genuinely need support. And for that, the wonderful thing that has been done by the government is proactively they have given 2-3 subordinate debt. You are aware that 20,000 crores has been set aside for that. And more importantly, this 3 lakh crore of additional 20% line offered to each MSME, which was a standard asset as on 1st March. So basically what that means is that roughly the total standard asset outstanding of all MSMEs put together in the banking system is around 15 lakh crore. Okay. So the government basically went ahead and told the banks that up to 3 lakh crore, we are giving you a fully guaranteed scheme. You go ahead and lend another 20%. You don't have to worry about it because if it goes wrong, then we will guarantee that and give this money to them. So that has been fairly well utilized. 1,50,000, 60,000 crores of sanction has happened. Even disbursement has crossed. Almost all the banks have done it up to there. So this kind of support has also been given and supporting, bringing in equity. And so a whole range of things is being done because the realization is there that MSMEs will play a very key role in revitalizing. Simultaneously, one other thing that has happened is, which is not directly linked to COVID, is the global scenario has also been changing. It was changing even before COVID, especially details I will not get into, but we are aware of what is happening between China and the rest of the world, specifically between US and China, and how that can impact the global supply chain. And the government has been very cognizant of that and very wise about it. And what they have gone ahead and done is made these announcements relating to Atmanirbhar package. So as and when various companies, whether they are the corporates or they are the MSMEs, as they do their new planning in the new scenario, they can take all this in together. Given this backdrop, I'm coming to answer your question was relating to the bad bank and NPAs. Given this backdrop, it is very difficult to predict what the actual rise will be. Absolutely. So conservative assessors and experts, they will always, err on the side of caution. They will say that it can become this much, and various numbers have been given. Even RBI has put out some number, and it may well actually come true to some extent. But my sense is, given our own book, what we see in SBI, and the fact that various industries have actually been performing quite well since the unlockdown has happened, my sense is that it may be very much below the very bad scenario that we are thinking of. And therefore, the need to immediately see a huge rise in NPAs, we will get to know from the December quarter, because September quarter we will not get to know because it is only 1 month. But December quarter results of the banks and March quarter results will be very good pointers. But my sense is, whatever we are fearing, it will be well within that. I may stand corrected, hopefully not, but I think it will be well within that. And the concept of a bad bank that you mentioned is basically one of the resolution mechanisms, right? So the idea is that the bank's balance sheet remains, the capital that is there with the banks is utilized for growth. So that I think the banks will ensure whether this particular proposal comes through or not. At this moment, we are not really able to say that whether so quickly such a major decision can be taken. But yes, growth has to come back. And I think one of the ways will be, apart from MSME, will be infrastructure.
Absolutely, and that's something which is going to get us growth back. So with this, a couple of positives that we've seen, even if you talk about SBI, is that the loan book which has been under moratorium is coming down, which is lower than most of the large and mid-sized banks. So that's something which is a positive as well. Apart from that, we have seen a reduction with regards to corporate NPAs, and that is also substantial if we talk about the first quarter of FY21. Now, putting all of this together, along with the measures that the RBI and the government is resorting to with regards to, say, restructuring, do you think the strength of the balance sheet will pick up, or do you think for that also we will have to still wait for another quarter or two to understand the entire impact?
No, so I'll go back to what I said, that as on the 31st of March, we had a very strong balance sheet.
Correct.
So balance sheet, when you are saying is strong, means what? Two things. One is all the bad loans, whether you have recognized them. And that, because of Reserve Bank now, there is no delay in doing that. We are, in fact, we do it proactively. Sometimes an account may not have actually slipped into NPA, but we recognize and start providing for them. And overall, the provision coverage ratio of bad loans has gone up to 86%, right? And even if I look at the corporate book, it is as high as 85%. And these numbers used to be 65% and so on. And after doing all that, we have a CRAR, which is historically the highest, or within SBI. So we are above 13%. So we did start with a very, very strong footing, and which once your pre-provisioning operating profit, which basically comes from your normal course of business, right? Your normal lending and things like that, and the growth that we have projected. And this first quarter also, that has broadly been borne out. The first quarter growth for SBI has been actually higher than what it was in the previous year, even in the loan growth. And I think in the analyst conference after our first quarter results, that is June results, we have gone on to say that it will be somewhere between 8 to 10%. So even if I maintain that throughout the year, if I am not able to further increase it, I will have a very, very healthy pre-provisioning operating profit because of the income that I will have from both interest income as well as non-interest income. And after that, it all depends on how much of my book actually slips, in the sense that we need to either slips or we need to do the deep restructuring, which RBI is allowing. So based on that, my sense is that the amount of reserves that we have currently, because of the already existing very high provision as on the 31st of March, and this I think is true for all the other good corporate banks, the larger banks, we will be not in any major difficulty. Because see, you have to realize that we have faced 2016, 2017. Our own assessment is that this year we were hoping, last year we had a slippage ratio or total amount of bad loan provisioning of say 40,000-45,000 crores. Okay. This year we were hoping it will be cut down by half. Because now COVID has happened, our own assessment, one of the assessments that we have is, at the worst, we'll come back to what we were in 2019-20, and which allowed us to declare a profit of 15,000 crores, which is not bad at all. I'm just giving you a...
Correct.
But at this moment, any assessments can only be, conjectural. But we are doing that only on the basis of the track record of the cash flows and the way the companies, because each and every company is under watch now, right? That is what we are doing. Earlier, you all used to ask whether what is a watch list and things like that.
Correct.
Here, we have made sure that every company, so we have about 2,200 corporates financed by us, each and every account is being closely monitored. We are seeing what is the cash flow, what has happened this week compared to the previous week. We are very closely engaged with the companies. And based on that, we find, as you have yourself said, that the cash flows are very good. So whatever we have declared on moratorium is based on the actual realization, not on speculation. So which is again good. So based on that, we feel it may not be as bad as we are fearing, but we will get to know the results after our December results and March results.
Right. So with this, Mr. Basu, when we've said that the slippage guidance remains at 1.5 to 1.6% in FY21, and this is excluding the impact of COVID, and we're looking at a loan growth of, say, around 8% in FY21, are these conservative numbers, or is this a broad guidance that we're looking at? And if we do see an impact of COVID, this could come down drastically, and slippages could increase.
Two clarifications. There is no guidance at all. So this is mainly a discussion on how our book has actually behaved. So far, it is because how it will behave going forward, we don't know. So it is just how it has behaved from say April to July, right? More track record we have. We know the larger companies and seeing their cash flows. And the only thing that we are saying is whatever I shared with you so far are more in the lines of realistic estimates. They are not guidance. They are a broad estimate which will have to be tempered by the actual results that will come in the quarter of December and in the quarter of March, right? So I can say anything, but unless I have my December quarter results and the March quarter 21 results, I will not know. But this is not I would not say either conservative or this is more realistic. The discussion that I did with you about the provisioning operating profit and the provisioning done, this is more of a realistic estimate. Obviously, if the things are worse than that, then our conservative numbers will be worse than that. And if things are better than that, then our numbers will be even better than that. But that we will get to know only after December and primarily more or less after March 21.
Absolutely. It's becoming really difficult at this stage for any business to foresee even what the next 3 months are expected to look like. I think everyone's taking it by the teeth to understand what's happening in the economy, how things are functioning. So a very well-made point that you can't really think of the next 6 to 12 months from now. You will have to take it by the teeth. But with this, how much support do you think is still needed to borrowers? Because the cash flow improvement has not yet happened, right? Businesses are still struggling. Now, for that, what's happening is even the loan repayments, the EMI payments that happen are coming in from the cash flows. Now, if the businesses don't get support in terms of additional liquidity because of no cash flow, do you think that could become a point of concern for the banking system as a whole and for the businesses? Because if there is no cash flow, payment of EMIs and all of that is at a standstill, which in turn could be an NPA probably 8, 10, 12 months down the line. So how do you solve that issue of providing additional liquidity when there is no cash flow?
Right. So on the issue of cash flow, it's basically linked to the sector. You have to, because as I mentioned in my initial remarks, that this COVID impact on the economy has not been uniform across the whole economy. Say for a start, two segments of the economy are doing very well. One is agriculture, because thankfully this year has been a good year for the monsoon. And even before that, I think the food grain production and things like that are looking very rosy. And things have actually, whatever indicators that we are being given is very, very positive for the rural sector, right? Which can actually be a very good portent going forward. One. Second, there are some sectors like infrastructure, for example. Certain infrastructure sectors came back into virtual normal operations very soon after unlockdown happened. Say roadways building, construction. Then things like work going on for various new projects, say gas-based power plants and the city gas distribution. And we are into very many infrastructure this thing. So they have also started opening. Power demand, which had completely plummeted, for obvious reasons in the month of April and May, came back very fast. In some states, they are at 80%, 90%. So many of the power units that we finance, they are reporting very good traction right now. There is no issue. And even other core sectors like steel, cement is doing quite well. So as I said, it's a mixed picture. But there are certain sectors which we know are already impacted and which will continue to be more deeply impacted for some more time, right? So therefore, based on this, the cash flow also is varied. So the two things will happen. One is the sectors which are impacted, they will see a drying up or a slowdown in the cash flows that they are getting. And possibly that is reflected. But we are in touch with those companies also. So those who already have got their cash flows back. And just to inform you, normally we meet our clients when we travel and all. But the intensity at which we are meeting at all levels has gone up tremendously because of the ability to connect to them on web. And they also have a lot of time because they are spending more time, sort of to themselves. So the number of meetings that we have had across at all levels, including my level and of course at our branch level and things like that. So the corporates that I have talked to, many of them have actually saying that my cash flow position is fine. For the who are still impacted or will continue to be impacted for some more time, there will be two things. One is many of them come from very strong promoter groups. Okay. So it's not that they have one business. So maybe they have businesses in varied sectors and the group holding company is impacted in one or two sectors. To maintain the position, no one wants to take extra finance or get a restructuring done and things like that. So they will be able to. But there will be some who are in monoline businesses who could get impacted. So those companies are the ones with whom we'll be in very deep discussion. As far as our bank is concerned, very realistically, actually, there are not too many such companies at the moment that we foresee which will be placed. But yes, what MSMEs across the board, a very large proportion of them might need some kind of support. And this has been recognized upfront by the government, which is why the government schemes have come in very handy for them. So with a 20% support given by the government, additional 10% support given by the banks themselves, then moratorium extended, they are reasonably comfortable. And as things open up, they should. So again, this cash flow question is overall linked to the other issue of how much stress these companies will go through. And it is still, I would say, early days, but the initial portents are not as overwhelming or as ominous as it could have been.
Right. So, Mr. Basu, with this, if you think about the kind of rate cuts that the RBI has done, it's spectacular that they've really acted fast in the initial phase with regards to rate cut, and it's commendable on that front. Now, with this, it was anticipated that in the last monetary policy meet as well, that probably they would take a pause, though there is room to go ahead and cut rates, and probably they will start acting when it's rightly needed, because you don't really want to wait and waste something like a rate cut at a time when it's not needed right now. If you have to look at the quantum of rate cut that has happened, how is the transmission looking like from the banks?
So transmission has been excellent. In fact, this was one of the rare occasions in the last monetary policy on 6, when RBI governor just only complimented the banks by saying that whatever we have cut, it has got transmitted almost entirely. So I think for SBI, it has been like we have transmitted the entire 115 basis points, which has been cut by RBI in the last 1 year and 1 year quarter and stuff like that. So everyone was cognizant of that. We managed our asset liability book in that particular manner and went ahead and got this done. So, because there was a need to give finance at reasonable levels also because interest cost, and that also has happened, and it has happened significantly. It has happened even in the retail segment, that is all the home loans and all that. And there are two other things which I would like to mention in this, that you rightly said, the decision taken by RBI this time. So number one, you don't waste your firepower when it is not required. You have significantly brought it down. Second thing that could be mentioned is that while it is expected to ease out, in the last 1 month or so, there has been a kind of rise in what they call inflationary expectations, at least. You know, because typically it happens around this time of the year, and once the crop starts flowing in, it eases out on its own. So RBI, for both the reasons, I think they did a very wise thing in keeping it. There is sufficient liquidity already available in the system, and I don't think this will create any issues in the banking system.
Right. And with this, on the back of COVID, another trend that we've been seeing, Mr. Basu, is the deposit base of banks has been increasing. Now, people are not really wanting to spend that much because there is uncertainty with regards to job losses, whether businesses will function, in full form or not. And due to this, there is a possibility of what's happening is that the liability of the banks in terms of interest that has to be paid out is also increasing on the deposits, whereas the number of people coming in to borrow money is still less because of the businesses still not up and running. Do you think that is something which could be a cause of concern for the sector?
So on spending, of course, apart from the fact that, spending has come down to conserve cash, which I think is a good thing, especially for businesses. This is in this kind of situation, not in all situations, because as a business, you are required to take risk. So if the banks don't lend, that is not a good thing. So neither it is for a normal business also, it is not a good thing. But in this situation, some of it is due to compulsion. If you look at us, how much can you buy over Amazon and things like that? Unless you go, I'm quite sure that in the last 3 months, you would have gone to so many malls and purchased, on a lighter note, purchased so many things for yourself, which you just don't have the luxury of doing because you're stuck at home. So I think these things will get corrected as and when people will feel, because malls in Bombay have actually opened. But you and I will still not, unless we are compelled to for some reason, we would not like to actually take the risk and go there. Once that thing eases out, I think spending will come back, both in the individual segment, the personal segment, as also in the business segment. And about your question relating to banks supporting, I think it's linked to the other things that we discussed. Yes, it is important for businesses to once again, start their flow of activity, and opportunities are now coming because government is on a very calibrated manner given a signal. It may not happen in one day, but over a period of time, at least in sectors where we should try and become as much as possible self-reliant. So that will throw up a whole set of opportunities for businesses to think of viable models in which they can put their money in and start producing. So, and banks will be ready because there is another thing which I wanted to correct, that banks have stopped lending and all that. We did an analysis actually in SBI, at least in the corporate segment. Yes, MSME, we had slowed down a little bit for various historical, we had a very large book and things like that. But in the corporate book, we did an analysis of 1819 and 1920. 1819 and 1819 SBI corporate book, actually we declared that we grew by 15%, which is very good. 15%. If I compare the outstanding as on 31st March 18 and 31st March 19.
Correct.
Okay. So 15% is huge. But actually, what happened in 1819 and 1920 is that when we declared our growth, we also take into account the NPA book, right?
Correct.
Till the time these things are taken away from our balance sheet,
Mm.
they remain a part of the corporate book, correct? So in the years prior to 1819, what was happening was, in a particular year, the amount that would go off from the balance sheet would be around, in the corporate book, would be around 5,000 to 10,000.
Mm.
Both 1819 and 1920, the amount that went off from the corporate book was more than 55-60,000.
Mm.
So additionally, 50,000 crore of my outstanding came down. So if I were to add this to my corporate book growth in 18-19 financial year, it goes up from 15% to 22%. And if I were to add it in this financial year, where I had a flat, I think it was 1% growth in the corporate book in 1920, if I add this 50,000 crore, which all happened due to SR Steel and all that. So, and this is not that it happens every year.
Correct.
This is additional decline that I saw in these 2 years, right? If I add 50,000, then my growth is around 8 to 9%, which is, given the kind of slowdown we had in the economy, which is not too bad. And on top of that, you need to add the additional growth that we had in the bond market, the debentures and commercial papers. Many of the good corporates, the outstandings, including the bank loan, the NCD and the CP, were at a much higher level at 1819 and 1920. So given all this, the corporate loan book growth has not been bad at all, even for a bank like SBI. Retail, we have already declared that we had around 13-14% growth in the previous year, which is reasonably healthy. We can do even better than that, but 13-14% with our base, anyone will take that. And SME and agriculture, it was a little slow because of certain reasons. But this year we have come back in a very big way. And in the first quarter, we have shown very healthy traction.
Right. Mr. Basu, but what's happening is, when I'm talking to NBFCs as well, or even when I talk to, we do surveys, housing finance companies, they have not been transmitting the rate cuts to, the retail clients, the customers. And the only reason that we hear from them is that the full transmission on the money that we borrow from banks has not happened to us. And that's one of the reasons why they have not been giving the benefits to the consumers. And in turn, the consumers now want to move their loans from the housing finance companies to the banks, because the banks still have a lower housing interest rate. And the banks are saying that because if someone has taken a moratorium, we are not really ready to onboard the new clients, So how does this problem get solved?
So there are, yes, this is one of the theories that are going around, but there are many fallacies in this argument. Okay, I'll try to point them out one by one. Right. Number one is, the reason why NBFCs are there is because they directly do not compete with the banks. Correct. Yes, both of us give housing finance. There are NBFC housing finance companies. But barring some of the larger ones, like maybe an LIC Home Finance and HDFC, which is virtually this thing, if you leave these two out, all the other home finance companies that are there are basically catering to a niche segment. So essentially, as banks, we have very structured processes. And it has to be. It is all India. We basically do the same kind of credit underwriting, take in the same kind of client, same LTV, and we basically go by documentation which is available. Like you take an income tax return, this and that is there, you belong, you work for them, and you come forward. There is a large segment, especially in the affordable housing segment, where while we do a lot of that, but NBFCs and home finance companies have a niche experience. So they charge typically higher interest rates to these kind of clients, but they understand them and go and finance them, and they were doing it quite well. And that is why this concept of co-lending also came to some extent, securitization. So because you are not number one in the same segment, so the first fallacy is to say that, this segment is now moving on to banks because the banks are not passing on the interest rate cut is a fallacious argument. It is not fully correct. It may have happened in a few cases, but that is not true. Second is the other main thing that you are saying, that itself is incorrect, because we realized that after all the measures announced by Reserve Bank, especially, and on the TLTRO schemes, the targeted operations that Reserve Bank did, and the PGS, the partial credit guarantee scheme, the spread, so the way NBFCs or home finance companies borrow is twofold. They take loans from the bank. They also borrow from the market, which had become a challenge because of all these ILFS, DHFL and all. But that has now come back. And banks have actually, through the PCGS and TLTRO, gone and once again started offering, making investments in these companies, number one. And the spread that has come down in the last post these measures taken, say, from June onwards, has been very significant. The spread at which they were able to raise, say, in July 19, if you were to compare with the spread at which they have been able to raise in July 20, I'm talking of the spread, not the actual interest. On an average, we have found out from the NBFCs is down by at least 100 basis points, if not more. So if they are making this kind of statement, the good NBFCs, the ones who are actually in the market and are doing proper work, they are not making these kind of statements. It has come down, and the actual interest rate obviously has come down, because if our MCLR is down, we have not increased our spread in any case. So if I have reduced my borrowing cost by around 100 or 115 basis points, it has got passed down. So both the interest cost of borrowing from the bank has come down, and even the spread at which they are able to raise money in the market, bond market, has also come down. So this argument is clearly inaccurate. There are some who are just making it because sometimes they just need to say something. But it is not an argument which we have. Again, SBI, we are privileged that we almost cater to almost every company, if not all of them. So more than 125, and I have personally talked to 10, 15 of them to verify whether what we were saying is right. But that is the issue. But yes, some of them are facing an issue relating to cash flow. And while it is back, in some of them, they are reporting 90-95% of cash flows are back to normal. In some cases, it is still a little slow, maybe at 50%, 55%.
Right. In fact, thanks for this clarification and insight as well, because it's really important for consumers also to understand as to, what are they dealing with, what's the kind of actual reality that comes in, because all of these theories keep doing rounds, and once people believe it, the negative is always focused first versus the positives that you see. But thank you so much, Mr. Basu, for joining us. Great conversation that we've had. I hope you enjoyed the conversation as well. And thanks for all the understanding. We will come back to you once again once things start improving, because I think the only thing everyone wants to now talk about is positivity, is positive growth, leaving behind all the negatives from here on. Thank you so much for joining in, and I hope you enjoyed the conversation. Stay safe.
Yeah, thank you. It was my pleasure. And as you said, we should stay positive. There is a lot of reasons for that.
Absolutely.
And do stay safe. And I'm sure we will see better days going ahead. Thank you very much.
Thank you.